We have ticker GTY. It's Getty Realty Trust. And I see there's one, there's another. We have 3 guests here, ladies and gentlemen, 3 execs on the stream for you from Getty. We have Chris Constant, we have Brian Dickman, and Mark Olear. I hope I got the last name there right, Mark. How you guys doing today? Thanks for joining.
Oh, thank you. Yeah, we're doing great. Appreciate you guys having us on today.
Absolutely, and it looks like you guys are all in different locations there, but that is fine. That's what this digital world is about today. I'll let you guys take it away and tell us a little bit about Getty.
Great. We've got a presentation which I think is up there. It is. But before we begin, I just wanted to say that I've been at Getty for more than 10 years. It's been a pleasure to watch the company's portfolio evolve over the years. We've got an excellent team at Getty that's constantly working hard to grow our business for the benefit of all of our stakeholders. It's been a real joy over the last decade or so. We're a triple net lease REIT, which owns more than 1,000 freestanding properties across the U.S. We specialize in owning retail properties which serve both the convenience store sector, said differently, properties which are associated with spending when consumers are in their cars. And we also own automotive retail real estate, which serves the needs of consumers who spend on their cars. We have a long history of investing in the convenience and gas sector. More recently began adding investments across the broader automotive retail landscape. As we think about allocating capital to our target asset classes, we're encouraged by the health and growth of both the convenient and automotive retail sectors. Our tenants' businesses at our properties are essential and have consistently met the day-to-day needs of the retail consumer. The convenience and automotive sectors have proven to be quite resilient across economic cycles and in fact grew last year in 2020 despite the COVID-19 pandemic. In addition, our target industries are evolving due to changes in consumer demand and technology, which create opportunities for us to invest alongside growing branded retailers who continue to embrace these changes and increase their market share through either new store builds or M&A. To elaborate further on our target asset classes, the C&G sector continues to grow as our tenants are increasing their in-store profits, which now make up roughly 60% of their gross profit. Much of this increased store business can be attributed to expanded offerings, such as packaged or made-to-order hot food and beverages, which adds to their already profitable traditional convenience stores and fueling businesses. Additionally, tenants have enjoyed success in driving additional customer visits to their stores through the use of various rewards programs and loyalty apps. Similarly, the broader automotive sectors that we focus on continue to grow as vehicle registrations and the average age of vehicles in the U.S. are both at all-time highs, meaning that consumers are holding cars longer and spending more to maintain these vehicles. Many of these automotive sectors, specifically the car wash business, are driving profitability through brand awareness initiatives and membership programs. These sectors remain highly fragmented, which provides opportunities for Getty. So turning to our portfolio, our typical property is between 1 to 2 acres and houses a 3,000 to 5,000 square foot building. Generally, our assets are located on a corner or in a high-traffic retail corridor. Today, roughly 75% of our base rent is derived from convenience and gas property. The balance of our income coming from either express tunnel car wash operators or other automotive service tenants. We prioritize properties in high-density and growing metropolitan areas. Our portfolio spans roughly 35 states, with 65% of our rent coming from the top 50 MSAs in the U.S. If you look at slide 8 of our presentation, my 2 big takeaways for investors are, first, that we have grown our presence across several high-growth markets in the southern half of the U.S., which was a key initiative for Getty when I became CEO a little more than 5 years ago. And the second is the growth over the same period has focused largely on 5 major markets, which now represent a significant portion of our base rent, being Columbia, South Carolina, Denver, Kansas City, Phoenix, and San Antonio. With that, I'm going to turn it over to Mark to run through a few additional slides in our presentation.
Yeah, thanks, Chris. I'll be taking us through slides 9 through 14 of the deck. From a tenant perspective, we focus on national and regional multi-store operators across the convenience and automotive retail landscape. These organizations are a mix of publicly traded and private companies, but all have the scale, access to capital, operational experience to succeed in this rapidly evolving business in the different verticals in which they operate. As a net lease company, our typical lease terms require that all occupancy expenses in excess of base rent are the responsibility of the tenants, with the portfolio of properties covered by unitary or master leases, with these leases containing annual rent escalators and site-level reporting, which gives us great visibility into the performance of the operating businesses. To that, on page 9, you'll see our various metrics, which will highlight the healthy tenant rent coverage ratio of 2.6 times. In our acquisition model, we typically underwrite to about a 2 times rent coverage threshold. So broadly speaking, the site level performance of our tenants is outpacing our assumptions in our acquisition underwriting. I would also add that this rent coverage ratio of 2.6 times has been relatively steady, including throughout the pandemic. If we move to page 10, as Chris touched on, our investment thesis as it relates to convenience and automotive retail real estate, I'll just restate that these are essential businesses which are both e-commerce and recession resistant, and that meet the evolving consumer demand for convenience, service, and speed across varied geographies and demographics. Additionally, we place a significant weight on real estate fundamentals, including the broader market characteristics and individual site attributes, which help drive the underlying land value and potential for alternate use. The retail verticals we target are currently highly fragmented, and consolidation by the operators has and will continue to provide Getty great opportunity to continue to deploy our capital. All combined, our focused investment strategy, detailed underwriting process, and lease structure deliver attractive risk-adjusted investments. Turning to page 11, our investment platform is highly targeted, and we have proven we can grow the company through a broad set of investment capabilities. We originate sale-leaseback transactions, we acquire existing leases, we provide funding for new store construction, which then transition to fee ownership upon project completion. We maintain an active asset management and redevelopment program, which allow us to deliver premium returns on investments from our older legacy assets. On pages 12 and 13, we highlight some of our recent investment activity. We've deployed over $600 million since the beginning of 2016, which has further diversified our tenant base, our geographic presence, and retail sectors within our portfolio, and has continued to prove our capabilities to execute across all of our asset classes. Regarding our redevelopment activities, summarized on page 14, we have successfully delivered 4 to 6 rent commenced projects over the last few years per year, and we expect to continue that in the near term. Returns we are generating on redevelopment invested capital for these projects continue to outpace what we could achieve in the acquisition market today, and we continue to identify additional opportunities in our existing portfolio. Our redevelopment program allows us to add high quality tenant diversity and also validates the strength of our underlying real estate thesis and markets in which we own our current portfolio. With that, I'll turn it over to Brian to talk about our balance sheet and other corporate items.
Great, thanks, Mark. I'll touch on pages 15 through 17 here, and then we will open it up for questions. With respect to our balance sheet on page 15, we currently have an investment grade credit rating from Fitch. We received that rating in 2018, and generally speaking, it's something we take a lot of pride in, having achieved that rating and maintaining an investment grade credit profile. Our liquidity and access to capital are strong. Our key leverage and coverage ratios are strong. Debt maturity profile, all very we think best in class as far as balance sheet construct, and importantly, the long-term fixed rate unsecured nature of our debt aligns very well with our asset base and our income streams. So in short, we believe our balance sheet is well positioned to support our growth strategies while providing downside protection should such a scenario ever materialize. Turning to page 16 and some information on corporate responsibility and ESG. As a firm, as a management team, we here at Getty are committed to being good corporate citizens and adhering to business practices, as Chris said at the outset, that serve all of our stakeholders. As it relates to environmental practices, we have limited control over our properties as a net lease landlord. I think most people appreciate that. But between the requirements we have in our leases for our tenants, various insurance policies, our own environmental programs, we believe that we're appropriately protecting our assets and the environment. Like many firms, we are continuing to evolve our policies related to social responsibility, but we are particularly proud of our gender diversity, our employee benefits and professional development, and most of all, a culture that we believe is inclusive and prioritizes treating each other with respect and professionalism. And with respect to governance, we recently in July enhanced the diversity of our board with the appointment of Evelyn Inferna as a new board member. And in general, we'll continue to identify and assess best practices and implement those that we think make sense for Getty. I'll flip to page 17 here to recap before we open it up for questions. A few, what we believe are key takeaways from my perspective, Chris and Mark's, that folks can take away today. First and foremost, Getty Realty. We're a net lease REIT specializing in convenience, automotive, and other single-tenant retail real estate. We are focused on growing and enhancing this portfolio of essential use assets. We want to be a growth company that owns stable, defensive assets in our target retail sectors. Our portfolio is characterized by durable rental income and versatile real estate with alternate use potential. Again, these are essential use assets. They're leased to national and regional multi-store operators. That supports that durable rental income. And as Mark went through, we emphasize real estate attributes and underlying land value in our underwriting. We operate in fragmented and/or high-growth retail sectors that's providing us with significant investment opportunities as those sectors consolidate, as our tenants grow, and as our tenants mature. And finally, our investment-grade balance sheet and credit profile is very well positioned to support our growth strategies and protect any downside as well. And with that, I think that concludes our prepared remarks, and turn it back to Brent for any questions.
Can you guys hear me? Hey, thanks a lot, guys. Nice presentation that you had there. I do have a few questions. So, just listening in, looking at some of the graphs and maps you guys were showing, definitely seems like your properties are all around the nation. I've been kind of asking this question to a few of our other companies and execs today. Which of your regions do you see kind of the most, quote, reopening happening right now?
Well, we've been prioritizing, dense markets and high growth markets over the last several years. I mentioned in my pages there that we've been focusing on across the southern half of the U.S. When the pandemic hit in early 2020, the markets that were hit the hardest were the Northeast and the West Coast. And we've seen those markets steadily come back, right, from a traffic and a store visit count. But I think you're really seeing, sort of two pieces of the country, across it, maybe the middle of the country, the southern areas of the country. You really never saw that much of a slowdown.
Sure.
Right? A fuel volume and a store visit count. So those areas have been very strong and been pretty resilient throughout. And then, West Coast, East Coast, again, you've seen a reopening. You're seeing a lot of people take summer road trips, which is helpful for our asset classes.
Right.
Obviously with the surge in the Delta variant, you're seeing more people delaying their office openings. So if you're a suburban commuter, right, and you use one of our locations, perhaps that's a little delayed. But I think you've seen from maybe the bottom and a little more than a year ago, you've certainly seen traffic and fuel come back up, but it's not all the way back to where it was pre-pandemic on the coastal regions.
Gotcha. Thanks, Chris. Cool question here from someone in the audience, on our YouTube audience, how do you see the shift to electric vehicles affecting gas station businesses? Do you think gas stations are ready for a change, or, I don't know if it's on you guys to try to help gas stations make those changes, but any quick thoughts there about electric vehicles?
Yeah, it's something that we spend a lot of time thinking about, obviously, and we talk to our tenants all the time. I think what you've seen over the last decade, or as I've seen in my time at Getty, is a steady evolution of the convenience side of the business that's been preparing for any sort of lost income from fuel operation.
Did you say convenience, Chris?
Convenience, yeah.
Gotcha. Yeah, okay.
When you think convenience, you're thinking of your traditional store items, you're thinking of beverages, you're thinking of food. Right. So what we saw in the pandemic, right, was more carryout, right, more prepackaged food.
Mm-hmm.
In the pre-pandemic, and I think post-pandemic, you're going to continue to see the rise of convenience stores that offer made-to-order or more sophisticated food operations, where you can actually go on an app, right, and order your breakfast, lunch, dinner, and that's going to drive additional profitability for our tenants.
Sure.
That if we do find ourselves in a scenario where there is lost income from the fuel side due to EVs, which we think is a little bit of a longer term trend, right? For our tenants, right? That profitability for our assets is going to be more than offset by that food income source.
Good to know. And if a Subway goes into a gas station that is one of your tenants, is that something that you guys would directly benefit from?
Absolutely, right?
Gotcha.
So when we look at new assets to acquire, a lot of our assets either have a branded QSR inside the store or maybe adjacent to the store, which becomes one of our tenants, or they're creating a private label fast food business inside their store. And, as we look at underwriting, what the appropriate rent is for a location, any income source that our tenants have or that maybe a subtenant would have, whether it be a drive-through or QSR or coffee location, is certainly helpful for our business and for the business of our tenants.
Great stuff. Thanks a lot for answering those, Chris. Appreciate it, and appreciate you joining, Brian, and also Mark. Guys from Getty Realty, that's ticker GTY. Thanks a bunch for joining, gentlemen. You guys have a good rest of your day.
Thank you.
Thanks, Brent. You as well.
Awesome. Again, ticker GTY.